Hey, good afternoon, everybody. Uneducated economist here. So, got a request to talk about credit default swaps. And so, I guess my first experience with credit default swaps, or the first time that I learned about credit default swaps, was during the '08 housing financial crisis, everything that went on during that. And AIG needed bailing out because they had sold off way too many credit default swaps. And so, I was new to the game, didn't know anything about it, economics at the time, and I was laid off. And so I was like, okay, what's a credit default swap? And so I typed into Google, credit default swap or CDS. And so basically a credit default swap, real simply, it's an insurance policy for an investment, right? And so if a particular investment, turns out to go sour or whatever, then or goes bad, then the credit default swap kicks in and pays the investor back their principal, or a certain amount of it, or whatever the contract is written for. Okay, so what ended up happening with AIG is that you got mortgage-backed securities, and if you're not familiar with a mortgage-backed security, it's a group of home loans, right? So you have like my loan, your loan, everybody's loan. Well, I don't have a loan, but everybody else's home loan. And it's grouped together into what is referred to as a mortgage-backed security. And these things are typically very secure because most people make their house payments, right? So during the '08 debacle thing, where people were like, there was a credit market freeze and everybody was losing their jobs and they weren't making their house payment anymore, you had foreclosures kicking in, and now these mortgage-backed securities weren't paying or paying off, right? And the credit default swap started kicking in, right? Well, here's the problem, is that AIG ended up selling off way more of these credit default swaps than they had mortgage-backed securities backing them. So like people who were shorting, like basically wanting to make money on the downturn of the housing market, bought credit default swaps knowing that people, or having the feeling that people were not going to be able to make their payments here in the future, and that by buying these credit default swaps, they would actually be able to, benefit from that with these insurance policies that were sold by AIG. And that's exactly what happened. So when AIG started like, oh no, we got all these credit default swaps out there that are kicking in because everybody's not paying their house loans and these mortgage-backed securities are starting to fail, they need a taxpayer bailout, right? So the taxpayers ended up funding a whole bunch of these credit default swap payouts, right? And now who ended up with that money is a very, there's a lot of conspiracy beyond, who got that money, as far as the taxpayer and who ended up buying all these credit default swaps. You think about it, if you buy a bunch of insurance policies and then raise the interest rates knowing that people were not going to be able to, have their jobs and make their payments and stuff like that, and you were going to benefit from that. Anyway, moving onward. So today I was reading articles out of Bloomberg, right? And there was a really good article that was talking about these credit default swaps and how a corporation who is defaulting on their loan. So basically, when a corporation wants to borrow money, they issue bonds, right? And they're basically, a bond is a contract to pay you back your principal over a certain amount of time plus an interest rate that's attached to it, right? And so they would sell these bonds into the market, and now a investor who wants to, obviously hedge their bet, they say, okay, I'm buying your bond, but I'm also buying this insurance policy to go with it, this credit default swap, right? So you have sellers of these credit default swaps, and you got buyers of credit default swaps, because there's a lot of people who just want to short that particular market by buying the credit default swaps, but they never actually have the investment to begin with, right? They just want the credit default swap. So that's where like a lot of hedge funds come in and stuff like that. Okay, so here's an interesting thing. So a corporation's defaulting on their loan, right? They can't make their bond payments, and they're going to start defaulting on their bonds, right? So that's going to kick off these credit default swaps, these insurance policies. So the corporation goes to the sellers of these credit default swaps, the people who are going to have to pay if they default on their loan or on their bonds, and they say to them, hey, if you give us some money, we won't default on our loan, and you won't have to make all those insurance payments, those credit default swap payments. And they're, that's like they're like, great, man, let's do the numbers. Either we have to pay out the insurance policy or we give these people money and they don't, right? And then they go over to the other people who are going to receive the credit default swaps, right? If they default and they say, hey, we're defaulting on our bonds here. If you give, and we're about ready to take basically a bailout from these people over here for not defaulting on our loan, why don't you give us some money and we'll default on our loan, on our bonds, right? So this is like an interesting play that the corporations now have with these credit default swaps, right? So they can actually, during these times of down, they can actually play these two entities against each other who are betting against them failing, right? Or one of them issuing an insurance policy against them failing, and the other person like trying to receive it. Now, this is what a lot of corporations have done, right? Is they will go to these credit default swap issuers and they say, hey, we're about ready to default on our loan. If you give us some money, it'll carry us along for a while. But the corporation knows they're defaulting no matter what, right? Even if they get carried along and get the bailout, it doesn't matter. It's just going to get them along for a little while. But the CDS issuers, right, the people who issue these CDS, they do it. And you know why? It's because at the end of the duration of that period that carries them along, the CDS expires, right? So what they're going to do is they're going to carry the company along just long enough till those issuing insurance policies that they gave out are expired and they no longer pay, and then the company goes under, and all those people who bought those credit default swaps are then out of money, out of all their premiums that they paid in. Pretty interesting stuff, right, guys? And then Sears. So Sears had an interesting play on it as well. Now they happen to have, when it came down to this credit default swap, it came to a bond auction, right? So what these bonds these notes ended up having to sell for when they went to auction. Now I tried wrapping my head around it, and it's a little confusing, but it goes, if I got it right, it goes something like this, is that if these notes that are carried within the company, they're a weird special note that aren't like typical ones, if they get into the market and sold at auction at a higher price, then the CDS buyers get paid higher money, get more money for this default, because Sears is defaulting, right? But if the issuers of the CDS buy those special notes and hold them off the market, don't let them go to auction, then the CDS payout is much less. Talk about getting strange, right? So either way, I think Sears gets to sell these notes at a certain price, because they're going to just restructure and come back or whatever. I'm sure of it. I mean, I don't know. Maybe they'll just go completely under, and then they'll just pay off all the bondholders, with that money. I don't know how it works, but anyway, it goes something like that. And these credit default swaps are now being played against each other, and it's awesome. I love it. The other crazy thing about this credit default swap market is that it is just gigantic, okay? It is so huge, so unregulated, so massive that it just dwarfs just about anything else out there. And I don't even want to give you a number because it's probably inaccurate anyway. So it's just, if you want to go and see for yourself, go to usdebtclock.org. And there's a bunch of numbers on there, but if you go all the way down to the bottom, you'll see one down there that's the biggest one you'll ever see, and it's the credit default swap derivatives market, and it is huge, massive, hundreds of trillions of dollars. Just put it that way. All right, guys. Hope that helps out with credit default swaps. Talk to you guys later.